Now, this is an interesting article from Forbes, how to collect $2,629 every month from investing in dividend stocks and like-minded investments. So let's dive into this. Generally, this is clickbait-ish, and I usually don't look at it too much, but I said, let's see what this guy's talking about, because it is of interest to me. I mean, $2,629, I don't have my trusty calculator, but that's what, 2,600, well, I guess I'll just get off my phone. $2,629 a month times 12. That's $31,000 a year. $31,000 a year. So that's not too bad. Let's see what we got. It's from Brett Owens. Dateline May 26, 2019. 60,000 people have read his article. So who's old Brett? I don't know who Brett Owens is. So let's go on down and see. He graduated from Cornell and left corporate America permanently at age 26 to co-found two successful SaaS software as a service companies. Today, they serve more than 26,000 business users combined. I took my software profits and started investing in dividend-paying stocks. Today, it's almost impossible to find good stocks that pay a quality yield, so I employ a contrarian approach to locate high payouts. To locate, I just got a thing to password required. Okay, so I took a contrarian approach to locate high payouts that are available thanks to some of the broader misjudgment. Oh, boy. Renowned investor Howard Marks calls this second-level thinking. It's looking past consensus belief about investment to map out a range of probabilities to locate value. It's possible to find secure yields of 6% or more in today's market. It just takes a second-level mindset. Well, okay, I don't believe any of that crap. But anyway, let's find out. So 17 monthly dividends to buy and hold forever. Mortgage payments, car payments, cell phones, blah, blah, blah. What do they all have in common? Nobody likes them. But more importantly, they all arrive relentlessly month after month. And that's fine when you have a normal job that pays you every couple of weeks or every month. But the regular bill routine becomes considerably more daunting once you hit retirement or when you go self-employed. I know that. All right, the problem is regular income coming from your portfolio of dividend stocks. They pay out quarterly, not every month. In fact, a lot of dividend stocks will pay out the big one in December, not was it March, June, September, and December. December is usually the biggest one. Investors, in turn, often build complicated dividend calendars that get knocked out of whack whenever they have to be cut back on certain stocks. May's dividend check might be enough, for instance, but June's won't be, and such and such. But those in the know have it so much simpler thanks to the rare but revered breed of monthly dividend stocks. Today I'll show you how to make the most convenient dividend payers on the planet, sending you $2,600 each and every month. Now again, this is from May 26th, so that's 2 weeks old. So look, things change every day, every minute things change. So just be advised. Monthly dividend payers that truly have their finger on our pulse as income investors. These companies know that many of their investors require these passive payments. They also know that the electric company doesn't start sending you bills every 3 months when you hit 65. It's actually not that difficult. Traditional quarterly dividend stocks will, every 3 months, announce a future payment with amount and dividend dates. Some monthly dividend stocks will do the same thing, but they just do it every month. Some, like Main Street Capital, Maine, will pre-plan in 3-month increments so that it dishes out these monthly dividends. So let's see. So the amount per share, 20 cents, 20.5 cents per share in July and August and September. So for the third quarter, you're going to get 61 cents per share. There's nothing stopping companies like Coke and Johnson & Johnson from doing the same thing. They just don't. By the way, even if you're decades away from retirement, monthly dividend stocks have a little something for you. They compound faster. And I thought this was pretty interesting. Compounding earlier and quicker is just more compounding interest. So stock A, a 6% yield, holding period for 30 years. If it compounds monthly, it'd be worth $34,987. Stock B, if it compounds quarterly, would be worth $34,512. So there's $500 difference roughly. If all else is equal, you come out slightly better with a stock that pays more frequently. So why not favor the monthly payers? All right, but who pays monthly payers? Real estate investment trust. REITs are among the most income-friendly assets there are, just by virtue of waking up in the morning. But several of them are monthly dividend payers, including the monthly dividend company itself, Realty Income. Business development companies, BDCs. They're extremely similar to REITs in that they were created by Congress and required to pay out at least 90% of their taxable income as dividends. The business is obviously different. They help provide financing to small and sometimes mid-sized companies, which often have difficulty obtaining liquidity from larger financiers. They also tend to sport massive yields, which tells me they're risky, but okay. MLPs. Most people think pipelines when they think about master limited partnerships, which is fair considering that most of them are energy transportation companies. But the structure extends to companies of all sorts, from private equity and asset management like Blackstone to diversified holding company Icon Enterprises to roller coaster specialists Cedar Fair. Yes, MLPs can be a normally tax headache. I'm just telling you, partnerships you just want to drop an anvil on your head, but they sport stellar yields, and from time to time they pay their dividend S distributions monthly. Royalty trusts are a niche as they come. These companies simply exist to own the mineral rights to things such as oil fields and mines. They collect royalties from the operations, which they then distribute to shareholders, typically until the trust itself expires or a certain amount of proceeds are distributed. There's only a handful of these companies, and they exist primarily in the U.S. and Canada. Preferred stocks, I've talked about preferred stocks many times, but I love them. Income happy that represent ownership in a company. They pay out dividends like a stock, but they're fixed more like a bond's coupon payments. They also trade around a par value like a bond, so most of the returns come from their massive payouts, often between 6 and 7%. You can invest in individual prefers, but investors typically opt to own them through exchange-traded funds like PFF and things of that nature, and closed-end funds from Nuveen. None of these include mega cap blue chips, but that's okay. There are still ample hunting grounds for high quality, high yields. Let me quickly introduce you to 17 first-level stocks and funds to give you an idea just how powerful monthly dividend payers can be. Each of these stocks yields more than the benchmark, occasionally by a little, but typically by more than double and up to 4 times as much. In all but a couple cases, their returns have handily beat basic benchmarks, and a few times they've outright walloped them. So I like this because it gives us the actual properties, the tickers and whatnot. A lot of people don't do that. They say there's a roundabout thing, and you got to do the due diligence. Look, I got no clue if any of these funds are good. It's completely up to you. I'm just reading this dude's article, but I like it. Gladstone, Main Street, Stag, I don't know anything about any of them, but here's our yield as of probably May 26 or something. He doesn't say what the date was, but anyway, I'm sure the yields are different now. But here's the S&P 500 is yielding 1.67 as of whatever this guy was writing. A 5-year total return is 66.58, but here are these other ones, significantly higher yields, significantly higher returns for the most part, other than LTC properties. Stag International, not quite. It's right around the S&P. Main Street Capital, Gladstone Investment, all good. Here's a Bloomberg Barclays U.S. Aggregate Bond Index. Is yield 2.83, a return of 12.76 over 5 years. Here's a corporate high yield fund. Municipal bond income term, I don't know anything, but ETF, and mutual fund, Vanguard Emerging Markets Government Bond Fund. So there you go. That's pretty cool. So all these have smoked the aggregate bond index. Of course, the reason they did is more risk, but still, what happens is, if you don't have a huge amount of each of these guys, even if 1 or 2 goes kaput, it's not going to kill you. Cohen and Steers Preferred and Income Fund. He doesn't have PFF in here. I'm surprised by that. That's returned 66.5% over 5 years, and has a 7.48% yield. I have no clue what Johnny Hancock Preferred, First Trust Intermediate Duration Preferred 7.8. I got no clue what these invest in. All right, and look at what this group of dividend dynamos is delivering. The average portfolio yield is 6.31, which is almost more than 3 times the S&P 500, which translates to $26.29 on a $500,000 portfolio. Not to mention, you're getting outstanding diversification. You got bonds, you got preferreds. You're exposed to business development corporations that act like mini private equity firms, investing in dozens of industries, or even tapping into the income potential of 7-Eleven and driving ranges. Disclosure, none. Yeah, I like that. So I'm a fan of this guy. I don't know how this could perform, but I kind of like this stuff. 17 monthly dividends to buy and hold forever. I don't know if it's interesting. It's interesting to say, look, if you're looking for income and you buy this assortment right here, this assortment of stuff, you're going to get the income. You're going to get some volatility in there for sure. Hopefully they don't go crank all at the same time. I have no clue what these would have done during the Great Recession, none at all. But I think this is pretty neat. I wonder if you could do that, something like that, just on a Vanguard funds. You got PFF. That's a Vanguard preferred, isn't it? PFF. Let's see. Vanguard preferred. Hold on just a second. It's PFF Is that a Vanguard ETF? I don't know. Hold on just a second. PFF. That's a preferred ETF, which I'm a fan of. I just can't remember if it's Vanguard or not. No, it's iShares. That right now is yielding 5.91. I'm a huge fan of preferred stocks, my friends. Vanguard preferred. I guess Vanguard doesn't have a preferred, huh? Interesting. So, thought you might like this. So, read away, do your own research, and we'll see you next time. Don't forget, smash the like button. That helps YouTube say, this guy Josh, he's doing okay. And they'll show it to other people. And he'll make me rich, I tell you. All right, we'll see you next time.